Good afternoon, everyone, and thank you for attending today's webinar, Benchmarking Your Practice, Key Financial Ratios to Increase Practice Profitability, presented by Deborah Ferris, President of Practice and Liability Consultants. Please be aware that there will be a question and answer portion today at the end of the webinar. To avoid frequent interruptions during the webinar, please type your questions in the question box located on the right of your screen. They will be answered in the order received during the question and answer portion. Additionally, the presentation slides will be emailed to all participants following the completion of today's webinar, and a recorded version will be available on the website for members only. Again, we would like to thank you all for attending, and I will now turn things over to you, Deborah.
Thank you, Bria. This is me, just so you can put a face to this voice that you're hearing today, and I'm very delighted to do this. As you can see from the title slide, I've been doing this webinar as a seminar for many, many years. I'm a key supporter of MGMA. I've been a longtime member. I'm actually the president of Northern California MGMA chapter last year and this year. So I have used the MGMA data throughout my career as a consultant, and I find it invaluable to help practices become more profitable, to really analyze them and benchmark them and see where their weaknesses are. So basically what I'm going to do today is teach you what I do when I go into a practice and do my consulting, because I really want to teach everyone how to do this, because they should be doing this on a yearly basis. So, you know, most of you managers out there, this is no surprise. Poor doctors, they're, you know, it hasn't changed. This was in 2005, but it's the same thing, you know. I mean, all the same things that are just really creating this burden for our physicians today. But I think this is so important. I mean, you know, MBA school teaches you Peter Drucker. He's one of my heroes. But, you know, we have to make a profit. We have to satisfy our employees and our customers, and especially in medicine, we have to be socially responsible. But we have to be profitable to just stay in business. That's one of the first things that you have to do, you know, to be in business is to stay in business. And I really like this quote. I mean, Harvard Business School, Robert Kaplan, it's so true, is that you can't manage what you don't measure. And so we have to do this measuring and benchmarking to see how we compare to our specialty peers. And, you know, for your baseball fans, if you don't know where you're going, you might wind up someplace else. So it's really critically important to do this. So what is benchmarking? Benchmarking is really comparing key financial data with your peers to identify these strengths and weaknesses. Now, you know, you have to look at the whole picture with this too. So if one ratio is out of norm, that's nothing to panic about. You have to kind of look at it overall and say, okay, you know, maybe there's a few ratios that are off, but are we really, our net incomes for our doctors are higher than what most of our peers are? Well, then maybe we can tolerate some variance here and there, but we're going to talk about that. But, you know, all other industries do this. So we need to do this in medicine, just like banking and pharmaceutical companies and all the rest of the companies around the country do all this benchmarking, and they do share key data practices to benchmark themselves. So with us, it starts with our profit loss report. And I really think in this day and age, we have to be with QuickBooks or maybe Peachtree, but it's got to be a double entry general ledger accounts payable package. So encourage your CPAs to do this, train your managers, and you have to explain to your CPAs that it's a management tool. Our profit loss report really is that. It's not just for tax. So MGMA has a suggested chart of accounts. You can access that. I use that all the time to explain to the CPAs that we need to be more discreet in our line item expenses, and that we're using that to really look for trends, to nip negative ones early. Now, I have a whole nother webinar on you know, avoiding and preventing embezzlement, but I have caught embezzlement by simply comparing profit loss reports and seeing, wow, one category in this one case was office supplies was way out of norm from the previous years. So I asked to see the QuickBooks data. I looked in there. She was reluctant to show it to me, the manager, and there were gaps in there of no identifiable vendor and check numbers, but large amounts. And sure enough, she was embezzling. So, you know, I think when you're able to compare this year to year and see that things are going up and down, that's maybe a cause for concern. but also to nip trends early in the bud, okay? So if you start to see some of your supplies going up, then maybe it's time to look at that, or your overtime, or whatever it may be. So scrutinizing and preparing and having your profit loss report monthly and cumulative year to date, and even better to manage it and look at it from prior year, is an incredibly useful tool. So obviously what we want is we want to be reducing our overhead as much as possible. We want to have that lean, mean fighting machine, as I call it. So, you know, again, MGMA is the gold standard for data. You know, I use the physician compensation report and cost survey report all the time. Physician compensation is already out. Not sure when the cost survey is going to be out. I'd say in a month or two. But that's, and the management compensation is already out too. I actually use the data dive. I find that incredibly helpful for me to be able to slice and dice data as much as I want to. My assistant helps me with that too. Practice support resources is another source of data, so I try to use as much as I can. American Medical Group Association, that's more indicative of large multi-specialty groups. And you're probably not even aware that we have a society called the National Society of Healthcare Business Consultants, and we publish our own data, and we actually do more specialties than most. And then I think that especially society studies are incredibly important. I mean, I know the ophthalmology and the orthopedic and the dermatology and the otolaryngology association, I think their deadline is just due today or something for their data. So, you know, I encourage all of you to always participate in those studies, because then you have very, very specially specific data as well. So when we want to do this, we want to say and ask ourselves, how does our practice ratio compare to norms? So we want you to be able to, you know, ideally use QuickBooks and do at least the basics in your own practice, or have your CPA prepare those profit loss reports with a column for each line item expense, and then divide it into the revenue or collections of the practice as a percent to collection. So you'll know not just what your total overhead ratio is, but each line item to norms. So that's really incredibly important. And, you know, the ones you want to pay attention to, obviously the most are staff and rent, unless you're oncology or, you know, people that have drugs, chemotherapy drugs, ophthalmology, retina with Eylea and Lucentis and things like that. You're going to have enormous drug charges as a percent to collections. So those are the two, you know, that I can think of off the top of my head that have some real, that usually their drugs are the highest than staff and rent. But for most of you, it's going to be staff and rent. So, you know, for those of you that are just new managers, your profit loss report is organized if you're a sole proprietor or a partnership, where the revenue is going to be on the top. Then all of the line item expenses are going to be listed. And again, this is what we want you to divide, like that 5,000 into the 600,000. That gives you 0.8% to revenue, that kind of thing. And then you're going to go all the way down the line, and you're going to have your total expense ratio, and that's going to be the 66.6%. And what's left over in the bottom of a sole proprietor or partnership is the MD net income. So that adds up to 100%. If you're a corporation, it's going to be organized slightly differently, and you're going to have the revenue on the top, and then you're going to have all of the expenses, but you're going to have your officer wages, which is your MD employees, owners, and that's going to be in a line item, and then, you know, your total expenses, but your corporate net income is going to be very little. But to get to the same overhead ratio, you just take out the officer wages, and you're going to be right back to that 66.6% overhead ratio. So you just have to adjust that. So remember, you always subtract out the owner wages. That's really important to get your true operating overhead ratio. So the one thing that's also very important is that I want you to separate out as much as possible. My recommendation is, not that I want you to, but my recommendation is that you try to line item out your staffing so that you can really benchmark even more discrete. So your physician employees should be on a separate line item than your officer or owner employees. And then your nurse practitioners and your PAs should be on a separate line item. And then your administrative people, your billing, your medical assistants, your front desk people, your medical records, all those should be sub-lined itemed out so you can see what total money you're spending on each staffing and what their percent to norm is. And I've got a slide that I'm going to show you in a little bit about how I analyze the practice. So this is just some current data. Some of my other slides have older data because I can't just give you all the free MGMA data. I want you to be able to purchase the reports and get the data dive or whatever it is. But I want to just show you what I do. So I get like say for a specialty, I will get as much data as I possibly can across this top from the various sources, and then look at all of the collections, what percentile they're in, net income, etc. So I can really see what's the ranges of the 20 percentile versus the 90 percentile for the various data sources. So that's what I suggest that you do. Get as much data as you possibly can, put it in an Excel spreadsheet, and then you can benchmark your physicians. So obviously you want to try to offer some ancillary services as well. So that has to be accounted for, and that increases your profitability, and that's very, very true today. So what we want to do, I love this slide, I've used it for a long time because I just like the visual, is that we don't want your hard-earned money going down the drain through careless management. So that's why it's so important to pay attention to all this. And I like this visual too, is that I want you to be, as a result of this webinar, I want you to be in the 24 percentile. Yes, I'm attentive to every penny my practice spends, rather than the bottom one. Yeah, they have a life of their own, and I just don't even pay attention to them. We need to have more attention to all these expenses, because reimbursement is, pretty stagnant, and so we have to do something on the expense side. So we want to, try to find, again, the same type of thing, the most data that we possibly can for the different expense ratios, and then we want you to put your practice on an Excel spreadsheet. What's your percentage of staff salaries to revenue? What's your percentage of rent? Things like that. And then your bottom line, where your total overhead ratio is. And interestingly enough, family practice and internal medicine has really skyrocketed for expense ratios with the amount of hospital acquirement of practices and foundations. So that's really added to the expense ratios, particularly for staffing and rent. So this is kind of just a visual. I like this, is that I want you to encourage your staff to help save money, okay? So you want to have everybody looking at this. And I really suggest that you try to have a quarterly contest with your staff members on whoever makes or saves the practice money with a good idea gets a gift certificate. So maybe it's $50 gift certificate someplace, or some sort of prize or reward. And the idea, of course, has to make or save more than the 50%. But that's a really good thing to do, because your staff have good ideas, and if they're motivated, which they need external motivation oftentimes to really come up with these creative ideas, they will do so. And then one of my practices, they took this to heart, and then I said, well, what about a yearly contest? Yeah, that's a great idea. So with they purchased vaccines. It was a pediatric practice, and they purchased them on the credit card, which they got free airline miles for that. And instead of the doctors using that, they gave the staff with the best idea that year a free airline ticket. And that staff member was so blown away by that and so grateful. And that's very motivational for the rest of your staff. So please think about doing some of those things. They really work with staff. They like those external motivation type things. So again, my hero, Peter Drucker. I love this. I mean, he was my favorite person in MBA school, and I just love the fact that now he's coming back into vogue again. And, it's so true, is that, I love this, is it's from the bottom up, from the front lines about, really encouraging your staff. So I was thrilled that he, this is all coming back in vogue again. It's not from the top down from administration. It's from the bottom up, encouraging them to think, give good ideas, participate, give input. So it's also very important to evaluate your doctor's productivity. And it's not just all about you trying to squeeze, blood out of a turnip with the expenses. It's also about your physician's productivity as well. So they have to do their part. And so it's important that you as managers really encourage them to understand and be motivated to be more productive. So again, this is about benchmarking and it's about key data. So you need to keep track of the number of patients you see, number of new patients to measure practice growth. And that's really important for new doctors that come on board. That's critically to a good administrator is going to, encourage them and show them that their growth pattern is increasing. Number of office, hospital visits, surgeries, procedures, or high revenue generation. And of course, the income generated by each doctor, the collections. So, I like you to have like a monthly productivity report. And a good manager, this is what I really encourage you, is that I believe in having a yearly strategic planning meeting with your physicians. And even if it's just a, one or two doctor and then the manager, that's still really important to do. And if you're on a calendar year, it's going to be probably September or October when you're starting to learn about maybe some reimbursement trends and you're looking back over the year to see what were your expense trends. So my advice is that you prepare an anticipatory budget for that strategic planning meeting where you have month by month done a budget that shows, okay, this is where we're going to anticipate where the revenue is going to go up, where we might have some expenses, what we're going to budget for physician productivity, because we know what our benchmarks are, our comparison for our peers about how many office visits and surgeries and procedures, and we're going to build that into our budget. So we're going to have a monthly budget, then we're going to compare what actually happened, what the variance is, and our year-to-date budget. So a good administrator then about, every quarter will talk to the physicians and say, hey, you're really on track with your budget for your productivity, or, you're a little bit behind. Maybe you might not want to take that, extra week of vacation this year. Maybe you need to catch up, or, halfway through the year and the doctor's done really well, you can say, wow, you're really ahead of your productivity. You can take that extra week of vacation and you're still going to be on target. So, I think data is what really wins with this. And physicians, remember this always. They're at heart scientists. They're evidence-based medicine. They like data, and they can really see what's going on. So obviously, reducing staffing costs, since that's your usually, other than drugs, your highest expense ratio item. So create good job descriptions, hold your staff accountable with good AR ratios that we're going to talk about. Use things like interns, college students, medical students for scribes that might be really low cost. And like I said, create those, this is where it was, ideas that make or save the practice money. So other benchmarking that you really want to do then is, what is your total staff payroll as a percentage to gross income or revenue or collections? Line item it, what's your full-time equivalent staff ratio to physician or providers? And that greatly varies by specialty. So if you're a neurosurgeon, it might be down to or a general surgeon, maybe down to 2 FTEs or full-time equivalents per doctor. But if you're orthopedics or ophthalmology, it could be as high as 6 or 7, or plastic surgery if you have a lot of staff with that. So that's why it's so important to benchmark with your own specialty, not just physicians across the board. So again, this is older data, but I don't want to give you everything. So you need to look at and find out what the current data is all about. So, again, this is just a visual that you can see a big difference between support staff by specialty. So, and then this is why you want to line item it out. So you want to find out what are your benchmark for, say, any more medical records. And if, it's about a third of a full-time equivalent, then you don't want to have more than that. And, maybe it's medical assistants. It's very different for general surgery versus maybe ortho or family practice. So you can use this data to say, okay, how does my practice compare, and what do I need to do to maybe make some changes? So this is just a visual of a typical engagement about what I would do when I would go into a practice and say, hey, here's all the different staff positions. This is the average hours that they work. what does that translate into a full-time equivalent staff member in that column? And then if there's 3.3 MDs, nurse practitioners, and PAs, then you have to divide each one of those, like an office manager. 3.3 divided into 1 is 0.30 FTE per provider. And you want to add those all up, and then you get your benchmarks next to it for full-time equivalents of your current years, what's your FTE, and then you can start to see, okay, well, we have a lot of, management. We're a little bit over the norm with our managers. In the front desk, though, we're a little under the norm. We're at 0.86, where our comparable peers have about 1.05. And then, you go down the line, we have medical assistants. We're slightly over the norm for, full-time equivalents. Maybe I need to adjust the FTEs and maybe make one of those medical assistants do part-time work at the front desk so that it'll lower our FTEs for the MAs, but will be more in norm for our front desk people. Will be more closer to the 1.05 if we, have a medical assistant do 15 or 20 hours a week up at the front desk and do both. So that's one way that you benchmark. And then your total FTEs, they're kind of in the range for family practice, but maybe just need to adjust the type of people. So you do the FTEs, then you do the wage. So you're going to look at their hourly wage, what that means per year, what's the total dollars, and then divide that into the revenue of the group. So you get your percentage that you're spending on all of these staff positions by category. And once again, looking at your MGMA or your data to say, what are we over? Are we under? Are we over? Are we under? And where are we overall? We're kind of under the norm, which is, pretty surprising for California in this case. We're sort of over heavy on the management and a little bit under the norm with everybody else. So, again, this is how you look at this. So the other way that you can look at this too is that, and like I said, when I go into a practice, if I can do this ahead of time, I know a lot about what's going on even before I get there. So I'm going to be looking for these things, and I'm going to be saying, okay, to myself, well, what if the wages are higher, but the FTEs are in norm? What could that mean? That could mean that either we're at the top of the pay scale, or maybe in San Francisco that has high wages. So we're going to have to suck it up pretty much with the wage because we have to do that for a very high cost area. But we're pretty much right on the norm for FTEs. Or at some point, maybe you have to say, these people are capped. I really believe in knowing what your local wages are. And that's why it's good to belong to your local MGMA chapter, that maybe they can share that information. There's no prohibition about sharing info on wage stuff. Or another great resource is salary.com. So you can do your zip code for medical assistants and find out what your low, median, and high wage ranges are. And those should be incorporated into your job descriptions every year. So at some point, a receptionist job in California isn't worth $85,000 a year, no matter how long they've been with you. There is going to be a cap at some point, and hopefully they're going to stay because they like it, or maybe it's time for you to encourage them to move on if money is the only reason that they're complaining about everything. So look at your staff salaries again. And your benefits to see, what are people offering so that you can recruit and retain good employees. But really, I think salary.com in your local area and MGMA data, if you can find local data, is really the best. Okay, so we're going to go on to the accounts receivable, and that's really important too. So you should always hold your billing staff or your billing service accountable for good ratios. And otherwise, either incentivize them or penalize them. And if your billing service isn't doing a good job, get rid of them. So even though you've outsourced your billing, a manager must stay on top of all these ratios. So, and this is just a little joke. I mean, it's just for the surgeons in the group or the surgery practices. I just thought it was funny. But we really do need to keep track of everything. So we want to know what our aging spread is. What is our percentage of AR in our buckets, okay? So we want to know exactly where we are. And Deborah's rule of thumb, and this is, again, this is national data, so it has a lot of hospital-owned practices and so forth. But and I found that that's really since I've analyzed the data for so long, that the accounts receivable ratios get worse when you're hospital and foundation employed most of the time. That's a generalization, but I actually found that physicians and managers in independent practices did a better job of this. So Deborah's rule of thumb is I don't like to see more than 15% in the 120 days and over category. And the more Medicare that you have in your practice, the lower this will be. So ophthalmology, very low, because they have a high percentage of Medicare in their specialty. So again, it's got to be specialty specific. But I think well-managed practices shouldn't have more than about 15% in the 120 days and over category. Because as it ages, you're going to have less likelihood of collecting. So you want to be working those accounts, and you want to make sure that your billing services and incentivizing their staff members to work those accounts and collect and not just write things off. So your other ratios and your billing people should know this. They should absolutely know these ratios and be held accountable for this. Your gross collection percentage is just real money divided by gross billed charges. And this can be anywhere on the spectrum depending on where you set your charges as a percent to Medicare. So this is a fairly meaningless ratio, but you still want to just collect it. But you want to distinguish it from your adjusted collection ratio or net collection ratio, and then your turnover ratio. So your turnover ratio is your AR ratio, what you have sitting out in uncollectible AR divided by 1/12 of your annual billed charges. So as you can see, it's about 1 month or so of well-managed practices. So you shouldn't have more than about 30 days sitting out in uncollectible AR. And that's because the faster you're turning over your money, the more you can pay your bills and pay your doctors. And this is really a performance measurement, and that's your adjusted collection ratio. And that's your real money that you brought in per month and cumulative year to date divided by billed charges minus contractual adjustments. And it's not each one to each. It's looking at it on a monthly basis and cumulative year to date. So the way I like to explain this is that if your charges are going to be higher than what you actually collect, if you billed $100 for a visit, but your PPO contracted rate is 75, you're going to send a bill to the insurance company for 100. They're going to pay you 75, and your adjustment is 25. So this would be 75 over 100 minus 25 is 75 over a 75, dividing. So it should be darn close to 100% as much as possible, but there's always some bad debt. So, again, Deborah's rule of thumb is for primary care, I like to see 96% and up. If you have work comp and like ortho and things like that, it can be a little lower. But well-managed practices should always be at 95% or better for this ratio. So this is really incredibly important. So those are the accounts receivables ratios that are really, just critical to collect and data. And I actually have a spreadsheet. I didn't think about that, but I have an Excel spreadsheet that I provide to my practices. And because I'm such an MGMA supporter, I will make this available if you want it. I'll send it to Bria after the program, and you can access her. And I think she's going to send out the PDF of this, so she can send you out that too, because I really want the managers to do this as a monthly and cumulative year to date. So I really hope that you'll take advantage of that and present that to your physicians every month. Okay, so appeals and denials, make sure staff has enough time for that. That's why you want to make sure you have enough billing collection staff as FTEs and wage to revenue, so that, and you can use that to say, hey, doctor owners, we're half of what our peers are for billing and collection people. No wonder we're having terrible collection ratios, because I always see that too. If I look at the ratios and then I look at the AR ratios, I'm talking about the FTEs and percent to staffing ratios, and they're under the norm, I can always bet the accounts receivable is not going to be that great because the staff are working so hard. They are just trying to get the bills out the door, and they're not spending enough time on follow-up and collection, appeals, and denials. So you have to be right-sized staff to do all that kind of work too. So you have to have payment plans. You have to put in writing. You know, you have to use things like care credit, payment plans, things like that. Very, very important. But stay on top of the AR. Make front and billing a team. They usually are at each other's throats. So we want to make sure that they guest visit and shadow each other, particularly when they're coming on board with your practice, so that they really understand what each other's jobs are. So the front desk understands when they make mistakes, how that screws up the billing on the back end. And the billing need to understand how front desk, how hectic it is up there, and that they maybe need to be more patient in teaching rather than complaining all the time. And I like to see, you know, some accuracy contests or some reward for being accurate with all this kind of information. So, you know, people are paying a lot more with health savings accounts. And so, you know, keep those HSA debit cards on file, take debit and credit cards, and make sure that you have really good firm policies that patients sign when they get their patient rights and responsibilities coming into your practice, that they know that they're responsible for their bill regardless of what the insurance company pays. Okay, hopefully this is not your practice. You know, that's the major complaint, you know, from patients about medical offices, is having to wait too long. But that's your job to also benchmark your physicians, to let them know about what is important. So, you know, it's coaching. We call this managing up, about you as a manager really educating your physicians on their productivity. As I said, I like you to do a whole benchmarking for each of your physicians per year so that you can really educate them and say, you know, doctor, you're at the 25th percentile of productivity, and that's why you're probably at the 25th percentile of net income. There definitely is a correlation between physician productivity and net income. So I try to encourage and teach my physicians this, is that if you want to be in the 75th percentile of net income, you pretty much have to be in the 75th percentile of productivity, and here's where you need to be. You're here now. This is where you need to be. Now, on the other hand, I had a family practice doctor one time that was really thinking that the manager wasn't doing her job, and the expenses were too high, and the staffing was too much, and everything else. So again, a full benchmarking showed no, they were actually in the norm. The issue was the physician productivity. But she also had a family, and she wanted to spend time with them. So I did an analysis about, here's where you are, here's what you could do by seeing another few patients per day, by spending less time with each patient, and what would that translate into net income, or adding another hour to your day and thus seeing increased patients and much more revenue and net income. And the bottom line is that when she looked at the difference about adding patients another hour of her day, and then also just cramming in a few more patients per day, she decided that it wasn't worth it, rather than, you know, spending time with her family. But now she was happy, and she wasn't complaining to the manager and thinking it was the manager's fault. So that benchmarking really can help you get across points with your physicians to help them understand the whole big picture. And because they don't usually, you know, they're not as data, they don't spend as much time with it as you do. But so that's your job, is to educate them as well on this. So like I said, budget is very, very important. Try to live within that budget. And I believe that everybody needs to be Excel spreadsheet literate. And there's day-long courses you can go to that learns all the basics. I have that book, Excel for Dummies, which is not that we're a dummy, but it's that little series. It's very, very helpful, and you can just Google online, you know, how do you do this with Excel, and you can get the answer pretty quickly. So this is what I'm trying to say, is that I want you to do monthly budgets for your revenue and all of your line item expenses, then what actually happened, what the variance is, and cumulative year to date, so that you can nip those trends early on and stay within your budget, and then, you know, hopefully your physicians will be really happy. One of the things that I usually try to do when I'm also, other than and encouraging MGMA dues and the letter of agreement with managers, is that I usually try to set incentive goals for physicians or for the new hires of administrators. And I usually have things like that through efforts of the manager, not through, doctors just working harder, that the manager has increased the net income for the physician. That's deserving of a bonus. Staying within the benchmark ratios for the specialty, for all the AR ratios and staffing and expense items. So those are things that maybe you can encourage your physicians to say, hey, I would like to, propose that at the end of the year, if I've done these things, that would be worth bonuses, because you'll make more money and then I will too. So I believe in that. I think incentives are good for the administrator and the manager as well as for the staffing. So in terms of productivity, I really would like you to keep those comparisons of, like I said, office visits for maybe the first quarter of this year versus the first quarter of last year, and then you can see where you are, so you can educate the physicians. You're a little behind in your productivity, but Dr. B is up. And then what's the collections, Dr. A and C are below and Dr. B is up, but maybe they're turning over a business. So there could be another reason for this, but it's very enlightening for physicians to look at this data. And that's what big medical groups do. That's what hospitals do. They are going to compare and contrast each of the physicians with each other, because they also know that's motivational. I kind of kid my doctors. I say, that's how you got into medical school, is you're competitive with each other, and you all wanted to be alpha, omega, alpha, and be on top of the class. Physicians are just naturally want to do well, and when they see that they're behind their peers, that's kind of motivational. So they'll try to work harder to be up with the rest of the rest of the group and try to do better. So that's why I find it's very enlightening. So I actually show them where they are. I say, okay, you're at the 25th percentile, you're at the 50th, you're at the mean, you're at the 75th percentile, you're at the 90th percentile, and all the doctors together so they can see where they are comparatively. So I think that's a good thing to do. Okay, so what we really want you to do then is consolidate this into simpler sheets. And we call it a dashboard or a flash sheet or whatever it might be. And I think all the data, the hardcore data is underneath, but I think managers distilling it into an easy to read dashboard, flash sheet, whatever you want to call it, so that they can really see where they are very quickly. Once that you have, as a manager, educated them on all these ratios, then they will know. So when you look at this and you see, okay, our adjusted collection ratio is pretty good. It's better than what it was, so that's a good thing. But our AR ratio has gotten worse, as we learned, because the higher one is not desirable. Last year was 1.5 months. Last month it was 1.7 months. This month it's 2.1 months. That's a negative trend, and our benchmark is 1.3. So manager, what's happening? And the manager should be able to answer that question and say, well, this month it's pretty bad. We have 2 people out on maternity leave, and so we're a little bit behind, but they're coming back next month and the following month. So we'll get that back down again. But if you can't answer that question, then that's not good. So you really want to be able to look at this. And then once again, when you look at their aging spread, and then 120 days, it's at 24%, where our benchmark is 15%. That's not a good trend. It's not a good trend developing. And our overhead percentage is 59%, whereas it was 48%, for example. The MGMA is just made up. But, these are the kinds of things that you want to distill into this dashboard, flash sheet type thing, so that your doctors can see at a glance what's really going on. So, I just wanted to point this out, is that I think this is another thing that you can educate your physicians about that's really critically important today, and that is that there's a direct correlation between Yelp and all the other health grades and vitals and everything else with higher ratings and less weighting. So 5 stars, low weights; 1 star, high weights, like high rates of weighting. So please use some of this stuff to tell your physicians and educate them that you know, social media is really where it's at right now with a lot of things. And if you're getting all these bad, you know, reviews because you're keeping people waiting, it's not going to be good. So it's also incumbent upon you to educate maybe some of your physicians that trained a long time ago that the waiting time tolerance has really shrunk, and it's about 12 to 15 minutes between the patient's appointed time and when they expect to see the physician. So that, you know, keeping them waiting for longer than that is not going to be conducive with a healthy, growing, vibrant practice anymore. So because of social media, it's just the way it is right now. And so that's pretty important. I just threw that in because I think it's another benchmarking thing that you need to help educate your physicians about. So I kind of, you know, I always tease my physicians. They thought they were going to have to just keep up with all of their specialty medical continuing education, but then they find out that they have to learn all this stuff that they never taught them in medical school. And I think that's so important for you as managers to remember, is that most physicians get none of this education about how to run their practice in medical school. They don't know. I mean, I'm teaching these seminars, and I can't believe that physicians that have been in practice for, you know, 15, 20 or more years still don't know AR ratios or don't know about their staffing ratios and so forth. So that's really your job as administrators, to help educate them on this and encourage them to be able to get this data so that you can help manage the practice better. And, you know, as we say, manage up to your physicians and really teach and educate them about these types of things. So with that, I'll turn it over to questions. And Bria, you want to come back on and help me out with the questions?
Sure. Thank you, Deborah, for a great presentation. I'm now going to read some questions from the question box, if there are any. If anyone has any additional questions, please type them in the question box now. It's located on the right of your screen. So I see, can we get a copy of the presentation once it's over? And that is a yes. I will be emailing all participants a copy of the PDF of all of these slides.
And I'll also send you right afterwards that Excel spreadsheet. You can send that out to them too, okay?
Okay, no problem. Are there any other questions? What are the current rations for the wages?
So are you like so happy?
Rations, sorry.
What is it? What are the current ratios for wages?
It says, what are the current rations for wages?
I think it's ratios, but anyway, as I said, that's very specific to the specialty and the years of data. So, you know, this is copyrighted data, so you have to be able to access this either by purchasing it or participating in the surveys. So I gave you a couple little pieces of current data, but again, it's, you know, you have to pay for this, unfortunately, or, you know, use people that have the data. But it's very specialty specific and it's very year specific. So it changes all the time. So you really do, it's, you know, unfortunately, I mean, MGMA makes, it's costly to have them put these things together. So they have to charge for it.
Okay, the next question is, we have been looking for staffing ratio models. We are a small subspecialty oculofacial plastics, but we cannot seem to find an industry standard for our specialty.
Yeah, that's tough. You know, I can tell you that even our National Society of Certified Healthcare Business Consultants doesn't subsectify into oculoplastics. So I think you're going to have to, for that specialty, you're going to have to look at a combination of ophthalmology and plastic surgery to sort of blend that together to see what the staffing ratios are. I really encourage, you know, practices to, for their specialty society, to, you know, talk to them and say, hey, you should be doing this. You know, we should subsectify into, you know, these subspecialties. So I'm getting a little background feedback. I don't know if it's on your end. I don't think it's from my end, Bria, but I'm definitely hear some other background noise there. So for example, I know that the AAOE, which is the ophthalmology executives, they do subspecialize and subsectify to retina data, for example. So maybe you can try to talk the Ophthalmology Academy into surveying just the oculoplastics and getting some, you know, specialty specific data for you. The more specialty specific, the better for everybody. But yeah, that's a tough one. I agree.
The next question is, how does our CPA interface with these management reports?
Well, I mentioned that, is that first of all, you've got to tell your CPA what you want from the CPA. And honestly, I don't know why any CPA in this day and age would encourage anybody to use Quicken. So QuickBooks is really the gold standard. And you have to explain to them that you are going to be using these profit loss reports as a management tool, and that therefore they need to, and I have had no problem explaining this to CPAs, to, subsectify the staffing, more line items for the staffing, separating out into line items, like I said, the employee physicians from the owner physicians and the staffing, so that you can really see that. The biggest mistake of all is lumping everybody into the same category, because then you really can't tell anything from that. So you just have to explain to the CPA that you're going to be using this as a benchmarking and management tool. Therefore, you have to have the data sectified into these more line item categories so that you can manage your practice better. I've never had any problem explaining that to a CPA.
Okay, the next question is, when staff has been here long-term and at the top of their wage range, what things can you do to keep them here without going over the range?
Right. Well, you have to sit down and explain that to them and show them what the ranges are, like I said, from like salary.com, or if you have some local MGMA data. And then just say, we would like you to stay. We would like you to be motivated. If you can help, save or make the practice money, like I suggested with contests, you can win a bonus for that. Maybe you're going to, give them a bonus for, taking on a new management task. So longtime staff members, one of the things that I see is that managers try to do too much. They try to take it all and do it themselves. And your job as a manager is to really groom your replacement and to try to teach people how to do some of the things that you do. And that's also very good for the organization. I see that happening too much, where a manager is the only one that knows how to do something, and then when they're sick or they leave, nobody knows what to do. So that's like holding the practice hostage. So you should be training somebody, that's motivated and wants to maybe make a little bit more money, by training them to do some of the things that you might be able to do, that you can offload and delegate. That's your job. So, you try to figure out ways that you can motivate them, that it's going to contribute something financially or smoothing. It doesn't have to be even financial, as a matter of fact. What if they just come up with a better idea for patient flow, some idea that makes things streamlining, whatever it might be, that you can reward them with some sort of a one-time bonus, which is, or maybe you can reward them with a half a day off or something like that, Maybe that's going to be more motivational to them than a raise. So you have to look for ways that can, and just ask them, what would be motivational to you if we can't give you a higher wage? What could you see that you could contribute to this practice that would benefit the practice financially or operationally? And we'll consider a bonus for that. So that's what I would do.
The next question is there a national standard for the number of dedicated FTE to answer phones? For example, if you get 500 calls per day, then you should have 3 FTE just to answer phones.
I have not seen that data, but that would be interesting. I'd love to see that kind of data too. I actually don't know if there's anything out there with that. That would be another good benchmark to collect data. But mostly it's just the FTEs to providers and the wages to revenue. But I think that's a great idea, quite frankly.
How would you implement benchmarking contract rates?
Benchmarking contract rates. I don't know. Oh, are you talking about PPO rates across the board? I'm guessing that's maybe what the question is. You would create an Excel spreadsheet the same way. You can't share that information with your peers. That's antitrust. So you cannot you can't benchmark managed care contract rates. That's just not possible because it's considered antitrust. But what you should do is your analysis yourself on your own practice, and put a spreadsheet and do all the Blue Cross Blue Shield, Aetna, Cigna, Health Net, Humana, United across the board, with Medicare at the first as your benchmark, and then your 20 top CPT codes down the bottom, down the side, and call all the insurance companies they won't give you every CPT code. So pick your 20 to 25 top CPT codes that represent 80% of your business. And you can submit those to your insurance plans, to the provider relations department, and you can say, what are my contract rates for these 20 CPT codes? Then put them into the spreadsheet and do it as dollars and then a percent to Medicare. So then you can see, like, maybe Blue Cross is paying you 98% to Medicare, and Aetna is paying you 105% of Medicare, whatever it might be. And then when you have a spreadsheet, a big spreadsheet like that, then you can take a look at that and say, what do I want to do with this? Do I want to try to renegotiate some of my rates for these companies? Or, or maybe even drop them from going out of network. If it's something we don't have much volume and they pay us really crappy, then let's just dump that one and say, we want to go on a network with you, but we're going to try to renegotiate these that represent, high volume, and they're just a little bit low, or they're really low, but we want to try to renegotiate. So that's another benchmarking thing that I think that all practices should do on a yearly basis, but you can't compare it to your peers. It's illegal. You just have to compare it to yourself, unfortunately. But that's a critically good benchmarking thing to do for a practice. You should be always analyzing your rates, and you should be increasing your billed charge rates every year. And you can't just leave those stagnant. So, I usually suggest 200% to Medicare, but that's up to you, what you want to set your billed charges there. Okay, so just everybody remember that you cannot share contract rate data with each other. Prohibited. Next.
Okay, great. Thank you, Deborah. I don't think there are any more questions for the day, so then we can wrap this up. Once again, all the presentation slides and Excel sheet will be emailed to all participants and will be available on our website to members only. If you have any additional questions, you may reach out to the presenter directly. And thank you, everyone, again for attending. And thank you, Deborah, for a great presentation. I hope everyone has a great day.
Thank you.
Thank you.